data in the world, but if you can't sell it effectively, 6% off exchange ratio, and I see a micro
validation we are seeing across the Sasa, who made 4 purchases totaling 1.
You're seeing a fundamental turnaround, but I
Absorbed the recent selling pressure. This is a crucial
River trading entering the stock.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
relative volume hitting 452.4 times the daily average. I want you to just sit with that number for a second. We're not talking about a standard breakout here. We're not talking about a healthy uptick in institutional interest. We are talking about parabolic, entirely anomaly level price action. And when you look under the hood, specifically at the data from February 26, 2026, the story gets even more intense. We saw 165,089 shares of off-exchange short volume, and that's out of a total of 294,212 off-exchange shares. So that is a 56.11% ratio, and it is occurring entirely in the dark. So the question is, are we looking at a fundamental golden age transformation in AI healthcare infrastructure? Or are we just seeing algorithmic volatility in a microcap stock? Because I look at the operational turnaround, specifically this new Palantir integration and the massive liability reduction, and I think it absolutely justifies this reevaluation.
Well, it is certainly violent action. I will give you that. It completely jumps off the screen. But the question we really have to answer isn't about the volume itself, right? It is about the source of that volume. You look at that tape and you see this golden age transformation. I look at that exact same tape, that same 56% off exchange ratio, and I see a microcap stock essentially being whipped around by high-frequency trading algorithms. And it's happening on top of a very fragile balance sheet. So while the tech sounds great, the market microstructure and the lingering financial deficits present just severe execution risks.
I see why you might default to the algorithmic explanation, honestly, given the volatility. It is the safe assumption when you see a chart moving like this. But I think you are missing the forest for the trees here. The volume isn't random. It's a lagging response to a fundamental operational turnaround. OneMedNet has successfully navigated what I call the Palantir inflection point. This simply isn't the same company it was 12 months ago. The market is just waking up to a new reality.
And I am not convinced by that line of reasoning at all, because the market structure suggests otherwise. When you have that level of dark pool activity combined with a company that, and let's be clear about the timeline here, as of February 2026, still operates at a $741,000 net income deficit, you have to look at execution risk. You're seeing a fundamental turnaround, but I am seeing a liquidity event for market makers. But okay, let's dig into your thesis first. You genuinely believe the pivot is real?
It is absolutely real. Just look at the evidence. On February 27, 2026, they commercially launched the IWRW platform, and it is entirely powered by Palantir Foundry. This is the exact moment the business model fundamentally changed. Historically, this whole industry, real-world data, or RW data, it has been completely plagued by the data pipeline problem. Researchers want data, but it is fragmented, it's stagnant, and it takes weeks just to clean it. With this launch, OneMedNet moved from just moving data around to actually solving that pipeline problem using what they call smart conversational queries.
Right, but smart conversational queries is, it's a great marketing term. It sounds absolutely fantastic in a press release, and it perfectly appeals to the current AI hype cycle. But the real question is, does it pay the bills? Does it actually fix that $741,000 deficit?
The numbers say yes, actually. We are shifting from inconsistent, project-based revenue to high-margin, reoccurring subscriptions, specifically their subscription search and data license products. And we have the financial proof that it is working right now. Look at the 2025 bookings. They hit $2.79 million. That is a 4.1-fold increase year over year. And if you zoom in on Q3 2025 specifically, bookings were up 815%. You simply cannot attribute an 815% increase in bookings to algorithmic noise. That is pure commercial traction.
That is a compelling growth percentage. I'll definitely grant you that. But we have to keep the scale in mind here. We are talking about $2.79 million in total bookings. For a public company, even a micro-cap, that is still quite small relative to the massive market cap fluctuations we're seeing on the tape. It's the law of small numbers, right? It is really easy to show 800% growth when you are starting from a very low base. But my hesitation actually comes from a different angle. I want to talk about who is actually buying this stock, because the volume tells a completely different story than just commercial traction.
We'll get to the institutional buyers in a minute, who are incredibly impressive, by the way. UBS, Vanguard, Exential. But go on, make your point.
No, I'm talking about the market mechanics. When you actually analyze the 13F filings and the transaction data from February 2026, you see the incredibly heavy hand of quantitative firms. Jane Street Group bought 108,157 shares. Citadel Advisors increased their position by 178.82%. These are not necessarily long-term value investors betting on your Palantir thesis. These are market makers. Their entire business model is to harvest volatility.
They provide liquidity. That is their function in the market. You can't have a liquid stock without them.
Statistic. That massive off-exchange short volume. I really want to break this down because it is so often misunderstood by retail traders. When you see a 56.11% short volume ratio in the dark pools, it doesn't automatically mean people are betting aggressively against the stock. It means firms like Jane Street and Citadel are printing liquidity to fill orders. They are facilitating the trade, often shorting to fill a buy order immediately and then turning around and covering it seconds later.
Which heavily implies there is massive buying demand that they urgently need to fill.
Yes, it implies demand, but it creates a very specific structural type of risk. It means the volume is artificial in a sense. It is high-frequency trading, treating OneMedNet as a highly active ticker. And when you combine that with the fact that the company has a quick ratio of just 0.1, which indicates severe immediate cash flow pressure, this creates a setup where the price can evaporate just as quickly as it spiked. You have algorithms churning the stock on one side and a company with almost zero liquid cash on the other. That is a dangerous cocktail.
I think you are conflating liquidity mechanics with the actual quality of the underlying asset. Yes, market makers are involved. They're involved in every liquid stock on the NASDAQ. But let's look at the turnaround itself, particularly what you just said about the balance sheet. You mentioned the cash flow pressure on that 0.1 quick ratio, but you completely ignored the massive cleanup that just happened. In 2025, OneMedNet reduced its total liabilities by $19.6 million. That is a 75% decrease.
Look, a liability reduction is great, but it is not the same as cash generation. You can pay off your credit card debt, but if you don't have a sustainable job, you're still in serious trouble.
No, but it clears the overhang. For a long time, institutional investors simply wouldn't touch this stock because the debt load was way too high relative to equity. That barrier is now gone. They have deleveraged specifically so they can focus capital on platform development rather than servicing debt. And frankly, they are getting very creative with their assets. Look at the digital asset treasury strategy. They used proceeds from the $1.7 million private placement to purchase Bitcoin. That is a very forward-thinking move.
I'm sorry, I just don't buy that as a positive development. You have a company with a quick ratio of 0.1, meaning they barely have enough liquid assets to cover immediate short-term liabilities, and they are buying Bitcoin? That adds extreme volatility to a balance sheet that desperately needs stability. To me, it feels less like a strategic digital asset treasury and more like a gamble to pump the asset base because the core operations aren't generating cash yet.
It is forward-thinking asset diversification. We are in an era where corporate treasuries need to be dynamic to preserve value. But even if you completely set the Bitcoin strategy aside, look at how the market absorbed the recent selling pressure. This is a crucial point regarding the actual quality of this turnaround. We saw massive exits in late 2025. Correct Capital sold 4.5 million shares. Discovery Capital sold 2.3 million shares. That is 6.8 million shares of heavy selling pressure that hit the open market.
Right, and it crashed the stock initially. It didn't just absorb it smoothly. The price completely collapsed.
But it didn't stay down. That is the fundamental key here. The stock absorbed that massive liquidation and then surged 44% to 90% in early 2026. If this was truly a fragile company, as you say, that kind of selling pressure would have buried it for good. Instead, the market cleared that entire supply, and now we have a completely new base of investors. The weak hands are out.
Okay, that absorption is impressive. I will certainly admit that. Clearing 6.8 million shares without going to zero definitely shows there is a bid under the stock. But it brings us right back to the central question of who did the absorbing. You see it as a clean handoff to quality investors. I see it as a handoff to algorithms and dark pool operators.
It is not just algorithms. You cannot just dismiss the institutional validation we are seeing across the board. Look at the data from the reporting cycle ending February 2026. UBS Group AG, literally one of the largest financial institutions in the world, increased their position by a staggering 17,317%. They now hold 113,735 shares. You do not increase a position by 17,000% by accident or for a quick HFT flip.
UBS is a massive, complex entity. That could easily be a client-driven order, or it could be a hedging strategy for a structured product they sold. Seeing UBS on the register is absolutely not the same thing as seeing a dedicated long-only healthcare fund taking a strategic, fundamental stake.
Okay then, look at Vanguard. They increased their stake by 32.48% to 1.3 million shares. Essential Wealth Advisors is holding 3.6 million shares as the largest holder. This is a clear professionalization of the shareholder base. We are watching a transition in real time from early-stage venture-style holders to global financial institutions and index funds. That provides a concrete floor for the stock price that just didn't exist before.
I come at it from a completely different way. I acknowledge those big names are on the register, but we really have to talk about how they got there. And this brings us right back to the dark pools. You have Virtue Financial disclosing a new position, Hudson River Trading entering the stock. These are the specific firms that run the plumbing of the market.
Why does the plumbing matter if the water is flowing to exactly the right place? If Vanguard wants the shares, does it really matter if Virtue facilitates the trade?
It matters because the plumbing is obscuring the true price discovery. Dark pools are specifically designed to keep these massive institutional buys off the public tape to prevent price spirals. When a giant like UBS wants to buy 100,000 shares of a microcap, they don't just hit buy at market on the NASDAQ, they go through a dark pool so the price doesn't jump 20% instantly. That is exactly why we see that 56% short volume ratio we talked about at the start. The market makers, Virtue, Citadel, are actively shorting into the demand to fill the order and then covering later.
Which perfectly validates my point. The demand is entirely real. The market makers are just doing their job to fulfill that genuine institutional demand.
The demand is real for now, but the public price action is artificial. It makes the stock highly susceptible to incredibly sharp corrections. If Vanguard stops buying, or if Essential simply decides to trim their position, the liquidity provided by those high-frequency traders vanishes instantly. And because the public float is being traded so aggressively by algorithms, the downside moves are going to be just as parabolic as the upside. It creates a false sense of security. You see UBS buying and you think, safe. I see Virtue managing flow and I think, highly volatile.
I think we can agree there is volatility. I am certainly not arguing this as a treasury bond, but I would argue the volatility is completely worth the risk because of the product utility. We aren't just trading paper here. There is a tangible, massive expansion of the network. The network has expanded 37% year over year to 2,130 sites. We are talking about direct access to 186 million exams. That is a massive, highly valuable data lake.
Having access to data is one thing. Monetizing it is a completely different challenge. You can have all the healthcare data in the world, but if you can't sell it effectively, it is just expensive server overhead.
But they are monetizing it, and they're doing it through regulatory-grade validation. This is the absolute smoking gun for the bull case. On January 22, 2026, OneMedNet announced that their data directly supported the FDA 510(k) clearance for the SCIDA Brain CT ICH software. This isn't theoretical, maybe someday AI. This is a real-world clinical application approved by the FDA running specifically on OneMedNet data. That proves beyond a doubt that the data is regulatory grade. Do you know how incredibly hard it is to get clean regulatory grade clinical data in this space?
It proves the data is usable, yes. And I will admit, an FDA clearance is a significant milestone. I absolutely won't take that away from them.
It proves it is essential. And they are expanding this utility rapidly across different verticals. Look at the partnership with Resorius for neuro and EEG data that was announced on February 24th. Look at the partnership with View Health on February 26th for autoimmune diseases. The autoimmune market alone is projected to exceed $166 billion. OneMedNet is aggressively positioning itself as the foundational infrastructure layer for all of these therapeutic areas. They are building the picks and shovels for the AI gold rush.
That is a very compelling narrative. But have you seriously considered the competitive landscape? You mentioned the FDA approval. Well, the ARK Invest thesis projects that AI approvals will make up 30% of all FDA approvals by 2030. That sounds great for the industry, but it also implies a massive, incoming flood of competition. Every major tech company, every health data aggregator is trying to solve this exact pipeline problem. OneMedNet is a very small fish in a rapidly expanding, massive pond.
Being a small fish with the only currently working plumbing and an exclusive integration with Palantir is a very, very good place to be.
If the plumbing actually holds together, the entire pivot depends on the Palantir integration working seamlessly at scale. We're basically betting the house on smart queries resulting in multi-year enterprise contract conversions. You cited that $2.79 million in bookings earlier. Great percentage growth, sure, but the market cap is violently fluctuating between $32 million and $72 million. If those bookings don't convert to recognized revenue and hard cash flow immediately, the valuation is severely stretched. The company is actively burning cash. Remember that net income deficit of $741,000? They need those new subscriptions to stick, and we just don't have the longitudinal data yet to prove they will over a 3 to 5 year cycle.
We might not have 10 years of data on the new recurring model, but we have the ultimate signal of confidence right now: insider conviction. When I look for truth in a microcap turnaround, I don't obsess over the short volume or the dark pools. I follow the insider's own money. And right now, the insiders are buying aggressively.
Insider buying is usually a good signal, I agree, but context matters there too.
It is not just good, it is overwhelming. Look at Dr. Jeffrey Yu, the Chief Medical Officer. He is the person who arguably understands the true value of the clinical data better than anyone else in the company. He hasn't just bought a token amount once. He has made 18 separate purchases. He has actively accumulated over 2 million shares. Then you have Thomas Casasa, who made 4 purchases totaling 1.8 million shares. These are people putting millions of dollars of their own capital into the stock at these current levels. They aren't doing that for a quick high-frequency trade. They are doing it because they see a massive disconnect between the current price and the platform's actual value.
Look, it is the strongest bullish signal you have. I will readily admit that. When the chief medical officer hits the buy button 18 times on the open market, that absolutely means something. However, I have to point out the divergence at the executive level. While Dr. Yu is buying, CEO Aaron Green sold 126,322 shares. Now, I know exactly what the bulls will say. It's just profit-taking, it's for taxes, and it's relatively small compared to Yu's massive buying. But it is a sale.
It is a tiny fraction of the accumulation. You're comparing 126,000 shares sold to nearly 4 million shares bought by you and Cosa.
It is a fraction. But when you combine it with the operating deficit and the algorithmic market structure we've been talking about, it just adds a necessary note of caution. If the CEO is taking chips off the table while the CMO is pushing all his chips in, it suggests there might be different timelines or risk appetites internally. Or perhaps the CEO is just more acutely aware of that 0.1 quick ratio we discussed. It just muddies the water for a fundamental investor.
Or it simply suggests that the CEO has different personal financial needs than the CMO. the aggregate insider sentiment is overwhelmingly, undeniably positive. You have the CMO, major shareholders, and strategic partners all aligning at the exact same time.
Let's bring this to a point then. We are looking at the exact same market data, the same filings, but we are seeing two entirely different futures. You see the birth of a data giant, I see a highly risky microcap pivot.
I see the beginning of the golden age of AI healthcare, and OneMedNet is providing the fuel that the entire industry needs.
So let me summarize my position clearly. OneMedNet is a deeply interesting technology play, but it is currently a high-risk vehicle. The massive volume we are seeing, that 452 times the average, is completely dominated by dark pool mechanics and high-frequency trading firms like Jane Street and Citadel. They are churning the stock for fractions of a penny. The company has done a commendable job cleaning up its debt, I will absolutely give you that, but a 75% reduction in liabilities doesn't fix a 0.1 quick ratio or a $741,000 net income deficit. They are relying entirely on a new, unproven subscription model to survive. Until I see those Palantir smart queries turn into sustainable, audited cash flow that covers their burn rate, I view this as a very dangerous trade driven by AI hype and quantitative algorithms.
And I view it as a structural shift that is already complete. The market simply hasn't fully priced it in yet because of the micro-cap nature of the stock. The liability reduction of 75% was the crucial first step. The launch of the Palantir-powered IRW platform was the second step. And now we are seeing the third step unfold right in front of us: massive institutional accumulation. When players like UBS and Vanguard increase their positions by double and triple digits, they aren't gambling on algorithmic noise. They are positioning for the long term. The FDA clearance for SCADA proves the core product works. The aggressive insider buying proves the leadership believes in it. OneMedNet just isn't a struggling microcap anymore. It is the foundational data engine for the AI healthcare revolution.
A revolution that, at the end of the day, still needs to pay its bills.
And with bookings up 815% in Q3, I firmly believe they will.
We shall see if the speed of that institutional accumulation can actually outpace the structural cash burn.
That is indeed the defining theme through 2030. It is a race between the data pipeline transition and the broader market's realization of its true value. There is certainly more to explore in these filings, especially regarding how those dark pool flows normalize over the next quarter. But the table is firmly set.
It is going to be a fascinating chart to watch play out, that's for sure.
Absolutely. Thanks for listening.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!